The unthinkable has happened. The final safety net for millions of Florida homeowners has just snapped. For years, as private insurers fled the state in terror, everyone pointed to one last line of defense: Citizens Property Insurance, the state-run fund that was supposed to be the bedrock of the entire market, the one company that couldn't leave, the one company that was supposed to be unbreakable. Tonight, that bedrock has crumbled into dust. After being slammed by a financially devastating hurricane, the state's insurer of last resort is billions of dollars in the red. It is, for all intents and purposes, bankrupt. And now, Governor Ron DeSantis, the man who repeatedly promised Floridians that the market was stable, has been forced to go before the cameras and do something leaders everywhere dread: plead for a bailout. A massive taxpayer-funded bailout that could divert billions from schools and roads to plug a hole in a sinking ship. How did it come to this? How did the state's ultimate failsafe fail so spectacularly? And what does this financial bombshell mean for every single person in Florida, and possibly for you? To understand how this happened, you need to understand what Citizens Insurance really was. It was never a normal insurance company. It was a paper tiger created by the state to provide coverage to people who couldn't find it anywhere else. It was supposed to be the insurer of last resort. But over the last 3 years, as private companies like Farmers and Allstate pulled out, the last resort became the only resort. Citizens' policy count absolutely exploded. By August of 2025, Citizens was insuring over $600 billion worth of property, a stunning number that had experts privately warning that the fund was dangerously over-leveraged. They were one storm away from a complete catastrophe. And this September, that storm arrived. They called it Hurricane Leo. It wasn't the big one they feared for Miami. It was a brutally compact Category 4 that made landfall near Pensacola. The devastation was swift and total, but the financial damage was far, far worse. Hurricane Leo triggered an estimated $30 billion in total insured losses. Because the Panhandle had also seen private insurers flee, Citizens was on the hook for a staggering $18 billion of that total. And here is the number that broke the state's back. Citizens only had $10 billion in its cash reserves and reinsurance. They were suddenly, instantly, $8 billion in the red. The safety net didn't just have a hole in it, it had been completely vaporized. The collapse of Citizens triggered a financial doomsday device hidden deep within Florida law, a law that gave the governor one of the worst political choices imaginable. You see, to cover a shortfall, Citizens has the legal right to levy something called a special assessment. It is essentially a bailout tax. And the most shocking part? It wouldn't just be on the homeowners who use Citizens. It would be a tax on every single insurance policyholder in the entire state. Your car insurance, your renter's insurance, your small business policy, all of it could suddenly be hit with a Citizen surcharge of up to 45% of the premium for years to come. A family in Orlando paying $2,000 a year for car insurance could see their bill jump by $900 overnight, not to cover their car, but to pay for hurricane damage hundreds of miles away. Sources inside the state capitol described the situation as total panic. The governor was reportedly furious, feeling trapped between two politically suicidal options. Option A, he could let the assessments happen and enrage every single person in the state who wasn't a Citizens policyholder. The political ads would write themselves. The governor raised your car insurance to bail out beach houses. It would be an instant political death sentence. Option B, he could step in and use the state's emergency funds and general tax revenue to cover the $8 billion deficit. This was the bailout, but that money would have to be pulled from somewhere else. It would mean slashing budgets for schools, roads, law enforcement, and healthcare. There was no good choice. It was a lose-lose scenario, and the governor had to pick his poison. On Friday, after days of frantic closed-door meetings, Governor DeSantis stepped up to the podium and made his choice. "My fellow Floridians," he began, "we are facing an unprecedented challenge to the financial stability of our state. To protect the savings and the homes of millions, I am today authorizing an emergency session of the legislature to approve a $15 billion capital injection into the Citizens Fund. This is a necessary, though painful step to ensure that citizens can meet its obligations and we can begin to rebuild." $15 billion, not just the $8 billion to cover the deficit, but another $7 billion to try and keep the fund solvent for the future. The backlash was immediate and brutal. A Democratic leader from Tampa called it a catastrophic failure of leadership and a blank check written on the backs of our children's education. A fiscal conservative from his own party in the Villages stated, "Our state is not a piggy bank for a failed insurance scheme. This rewards reckless coastal development and punishes the prudent." The public outcry was even louder. Hashtags like #NotMyBailout and Florida Tax Trap exploded on social media. The fundamental unfairness of the situation was lost on no one. A factory worker in Jacksonville was now being asked to bail out a condo tower in Naples. If you don't live in Florida, it's easy to dismiss this as a local problem. But the financial earthquake that just hit Tallahassee is sending tremors across the entire country. First, there's the credit rating. Financial rating agencies like Moody's and S&P immediately placed Florida's state bonds on a negative watch. A credit downgrade for a state as massive as Florida would be a disaster, making it more expensive for them to borrow money for everything, a cost that will inevitably be passed on to taxpayers for decades. But the bigger fear is contagion. State officials in California, Texas, and Louisiana are now watching in horror. If a state-run insurer of last resort can collapse this easily in a state as wealthy as Florida, what does that mean for California's wildfire fund or Texas's hurricane fund? It exposes the fact that the entire model of state-backed insurance might be a house of cards. It also threatens the few national insurers still operating in the state. They will now be forced to pay their share of assessments into a fund they competed against, further weakening their financial position and potentially causing insurance rates to tick up even in states like Ohio or Pennsylvania. This crisis is no longer contained. So here we are. The safety net is gone. The bailout is on the table but facing a political civil war. The financial stability of America's third largest state is hanging by a thread, and the rest of the country is nervously watching for the fallout. The governor has made his plea, but it leaves every one of us with a terrifying, unanswered question. Is this a one-time emergency to recover from a storm? Or have we finally reached the point where the cost of paradise has become permanently unaffordable? This bailout won't stop the next hurricane. It won't lower the temperature of the oceans that fuel these monster storms. It is, at best, a temporary patch on a problem that seems to be getting exponentially worse. What do you think is the right choice? Should the state bail out the fund, or should the pain be shared by everyone through assessments? Let me know what you would do in the comments below. If you found this analysis helpful, be sure to hit the like button and subscribe for more updates on this developing story. Thanks for watching. What's the right move for Florida? Comment below.